Hey everyone, it's Sean. Just wanted to give you guys your mid-April market update. There's a lot going on. We're in a full-fledged spring market, bidding war central over here. On top of that, refis are actually starting to boom again after rates having ticked up aggressively from mid-February all the way to just the last few weeks. We see actually a little reversal in course in terms of rates actually improving this past week. So that's been exciting. So still time to get those refis in if you missed out. And then we just got to talk about, the bidding wars that are happening. It is fierce out there right now. So it's really important if you're a buyer in the market to really be prepared, know your numbers, know what's going on out there, working with an amazing real estate agent. But it's moving fast. Things are closing faster than ever. We're seeing things like, way over asking price, 20 grand, 50 grand, 200 grand. I'm seeing all sorts of things right now, depending on the type of markets you're looking in and the type of properties you're looking at. We're having a lot of success out there right now. Our pre-commitment program has been a big hit. Just over the last few months, we've had clients get offers accepted because they've had their pre-commitment in hand, been able to close aggressively, close quickly. In fact, just last week, we took a few offers that are actually still because they were pre-committed, closing in April. So very excited about that. We're going to expand it. We're going to keep getting better at it. And we're going to keep putting our buyers in a better position to win and get their offers accepted. So I got two topics I want to cover with you guys here mid-April. The question I keep getting asked is, is this sustainable? Is the housing market going to keep increasing in price? In fact, Google reported last week that the search, when is the housing market going to crash, had spiked 2,450% just last month. Okay, so people are going into Google trying to figure out what to do. Obviously, people are stressed out, maybe a little overwhelmed. In my humble opinion, the market's not going to crash. And I'm going to give you guys a little bit of info as to why. But keep in mind, this is entirely different than 2008. I'm going to share with you guys 5 reasons I put together why the market in 2020, 2021, the housing market is not what was leading up to 2008. Now, this is nothing like last time because mortgage standards are nothing like they were back then. During the housing bubble, it was almost difficult not to get a mortgage. Everybody qualified for a mortgage. There was all sorts of insane, not practical mortgage products out there. You could put 0% down. You didn't have to have your income or assets checked. There was all sorts of names like Ninas and Ninjas and all these type of different products. No income, no asset verification. Today's the opposite. Getting qualified for a mortgage today, you have to have your income verified, credit verified, assets verified. The clients that I'm seeing getting offers accepted are the most highly qualified borrowers, low debt to income ratios, great credit scores, good down payments, reserves, and just the foundation of the clients getting mortgages across the country is much more scrutinized and much better than it was back in 2008. So I'm confident that should the economy change, should unemployment change, obviously no market source forever. The clients that got mortgages today will be able to afford their mortgages because there's not, negative amortization products. Most of the products we're getting right now, because rates are so low, most of our clients are, going with 30-year fixed rate mortgages. So they're locking in super, super low, all-time low fixed rates and low payments in for the long term. So I don't think that, last time it was largely due to the mortgage products, not verifying information, being almost irresponsible. Our industry was anyways, and a lot of people that were taking out mortgages were. It was a combination of the two. Now there's, Consumer Financial Protection Bureau, increased oversight. And, frankly, mortgage lenders want to put clients in a position where they can afford their mortgages and be able to make their payments on time. So that's a big reason why. Prices actually, over the course of time, now it might feel like they're soaring out of control right now, but, price appreciation was quite strong last year, but it's nowhere near the price appreciation that we saw last time. So as an example, back then in 2008, giving you an idea of a run up to it, in 2002, home price appreciated 8.5%, 2003, 8.7%, 2004, 12.5%, 2005, 11.5%. So every year it was booming. Compared to now, what's led up to now, 2017, 6.4%, 2018, only 4.8%. 2019, 4.7%, 2020, 9.2%. So obviously heated up as rates came down. I think we're going to see really healthy appreciation in 2021. Everybody's forecasting, 8, 9, 10% even, but also sometimes in certain markets as low as 6%. So, not the crazy run up for a sustained amount of time. It's starting to heat up now though. We definitely don't have a surplus of homes on the market. So last time there was a ton of homes on the market, massive surplus. Now there's a massive shortage. Inventory is down 25% to start the year, and the cycle's even moving faster, and it's eating into inventory even more and more and more. It's a big challenge for a lot of people. If they have a home they're going to put on the market, they don't know where to go because there's nothing to even buy. So that's it's creating a massive challenge. So the month supply of inventory needed to stay in this normal real estate market is approximately 6 months. Okay. Anything more than that is overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued depreciation. So we're definitely not at a 6-month supply now, nowhere near close. It's anywhere between 1 to 2 months. New construction isn't making up the difference in inventory needed. It's, new construction costs have soared. Prices of, we've been hearing about lumber prices through the roof. The supply chain's been disrupted. It's hard to get the permits and building and even just finding workers to build these new construction homes. So if we compare today to right before the housing crash, we can see that an overabundance of newly built homes was a major challenge then, but it isn't now. And then, homes aren't becoming too expensive to buy. The affordability formula, I've talked about this in the past, is 3 components: price of the home, wages earned by the purchaser, and mortgage rates available at the time. So I'm going to show you another different then and now. Back in 2008, prices were high, wages, however, were low, and mortgage rates were almost 6%. Okay. Today, prices are high, right? Wages have increased. We talked about last couple of market updates have been paying attention. Income's actually going up across the country. And obviously we're seeing unemployment go back down again, back to healthy levels. But mortgage rates in 2020, in some cases were in the 2s. In 2021, now in the low 3s, and even, still able to get some 2s in there. So, it's the affordability factor. Although prices are going up, income's going up with it this time, and mortgage rates have come down. Last time, prices were high, income was low, and mortgage rates were high. So totally different market. So it means, bottom line is, the average home purchaser, homeowner, is paying less of their monthly income towards their housing now than they were in the past, and even just a few years ago. And the last part is people are equity rich. Okay. Crazy stat I saw, prices have risen nicely, obviously, over the last couple of years, leading over 50% of homes in the country to have greater than 50% equity, right? Think about that. So there's a ton of equity out there. Last time, back in 2008, people were using their homes as ATM machines. You could put no money down. You could cash out all the way up to 100%. That's not happening now. Not even close, right? Down payment requirements are stronger across almost all loan products, especially on higher priced homes. You need much more of a down payment. Banks are more conservative. Cash out refinances are restricted. And then we've seen really, really nice, consistent home price appreciation. So definitely not maxed out equity. If people are in a position where they can't afford their home because there's low inventory, they can just put the house in the market and it will get multiple offers likely. So it's not like properties get stuck in the market. You're not seeing a lot of short sales, foreclosures, default, all that kind of stuff, because if somebody's in a situation, put their house in the market and it goes because they have equity, they're not underwater. So I don't think the housing market's going to crash. I actually think the housing market's healthy. Would I love to see more inventory? Absolutely. If you're a seller, put your home on the market, get it out there. There's a lot of people that want to buy it, but I wouldn't be afraid of it. I just think it's really important to know what's going on. Obviously it can be stressful and overwhelming if you're a buyer. However, I think, getting prepared, understanding the guidelines, understanding the products available to you, understanding your budget from a monthly payment, down payment, closing costs, understanding how amazing this rate environment is right now, and how important it is to get into the market now, because next year and the year after, home prices are going to be higher. Rates will likely start to go up at some point in the future, probably towards the second half of this year and into next year. So whatever you don't buy now is going to be more expensive next year. Your payments are going to be higher because you're going to have to buy in at a higher point, put a bigger down payment, and borrow the money at a more expensive cost. So I think it's really, really important to try to get into the market now. Don't let it overwhelm you. Just understand your options. Work with an amazing real estate agent, a great lender. Just put your team together and do your homework. So another interesting thing I wanted to comment on, I was trying to get into it a little bit earlier this week. I watched 60 Minutes this past Sunday night. Fed Chair Jerome Powell was on there. And, I walked away. It was a short segment. I'd highly recommend watching it. I walked away feeling really, really good from that, right? So he seems pretty bullish. He seems to think that, economic expansion is on the way. The economy's opening back up because we're doing a great job with the vaccinations. People are going back to work. People are moving back into the cities. In general, unemployment's coming way down. Certain sectors are booming and certain sectors that weren't. Hopefully, as things open back up again, we'll be doing better. But, he feels like we're at an inflection point to widespread vaccination and strong fiscal support, strong monetary policy supply. I mean, they pumped a market full of tons of cash, almost $3 trillion, and there's more on the way. So there's an oversupply of money on the market, and that's going to help things boom. I think we're going to see economic expansion across the U.S. like we've never seen before. He feels like we're at a place where the economy is about to start growing much more quickly and job creation coming much more quickly as well. He was saying that the outlook is brightened substantially, but obviously that's only if there's not another wave of COVID-19. If there's these different variants and whatnot don't kind of pose a problem. But if everybody's doing their part in terms of getting vaccinated, in terms of social distancing, in terms of just kind of supporting the economy, local economy, and just getting back to normal again, I think we're going to see a second half boom, hoping that it's before Memorial Day and July 4th and, this summer that, life gets back to normal for all of us. Last month, this is a key part. So the part that we've been afraid of is inflation going to really impact rates and start rates going up? I think that inflation will play a part in terms of rates starting to go up, and I think we're going to start to see that over the course of the next couple of months. But he was very clear. This is my biggest takeaway from it. He's not going to, and when I say he, the Fed and our government is not going to allow inflation to stop the fiscal stimulus and the support they're going to pump into the economy. That's not going to slow them down. They're going to deal with inflation. He said, that any increased inflation over the summer months would be temporary and not concerning for monetary supply or monetary policy at this moment. During the interview, he reiterated that the past economic cycles showed that inflation didn't increase much as unemployment went down. So he's not afraid of inflation. They're going to keep pumping money into the market. He's saying they can afford to wait to see if actual inflation appears before we raise interest rates, adding that the Fed wants inflation to move up 2% on a sustainable basis before it decides to raise interest rates. So cheap money is here to stay from the Fed for a while. I think everybody that's refinanced or bought a home wants to thank them for borrowing money at the cheapest rates we've ever seen, historic lows over, since we've been tracking them for over 50 years. If you haven't gotten your refinances in yet, if you're a homeowner currently, it's not too late. Get them in. If you're thinking about doing home renovation projects, if you have certain things that you want to do from a cash out perspective, utilize these historic low rates. I don't think we're ever going to see them again. I think that rates are about to start rising as some of this inflation does start to occur. Keep in mind, the Fed's doing everything it can to keep money cheap across the board, but mortgage rates don't always follow it exactly. So that's what, I was feeling good about in terms of watching Fed Chairman Powell speak. I think they're doing a great job supporting the U.S. market and the U.S. housing economy and, unemployment and all that kind of stuff. So it's good to see that they're focused and they're making things happen. So tips for you guys, that are watching this right now, buyers, as I said earlier, be prepared. Get your pre-commitments in. It's a great program we rolled out specifically to help put you in a position to win, help differentiate you from all the other buyers out there, allow you to close quickly with confidence while eliminating risk. Okay. Sellers, it's a great time to list. You're never going to sell your house for more money. You're going to have a million people begging to buy it, waiving all sorts of rights to do it, and getting aggressive to do it. So if you're a seller and you're borderline about listing your house, I'd suggest getting it on there and work with a great agent who's going to represent you. There's a lot of great realtors out there that are market experts that will market your properties and create bidding wars and get you the highest price. Agents, to all your realtors that are watching this, again, your clients need to be prepared. It's an overwhelming market. Multiple offers are tough. There's a lot of competition out there. So make sure they're prepared. Make sure they understand what's going on. Make sure they understand that things are going to be going over asking price, and that's normal. Let them know what they need to do in order to put themselves in a position to win. And the information they need to have. So that's all I got for this week. That's your mid-April update. I hope you guys are doing great. All of you guys in Massachusetts are ready for school vacation week. To all your families, I hope you have an amazing time. Thank you.